All right, to the big interview and the special conversation, valuation guru Aswath Damodaran only on ET Now. Where does he see the Indian markets moving? And why does he say that he will continue to look at Zomato's evolution? That, his take on Reliance Industries, the Tata Group, and interestingly, Paytm as well. So hear it out.
Many Indian companies are parts of family groups. And family groups are just, think of it as a collection of individuals, right? Some young, some old, some in the mid. So when you look at family groups in India, let's say you take the Reliance Group. The Reliance Group has some middle-aged companies. Remember, middle age is not bad. You can be very wealthy. Petrochemicals is the middle-aged company that throws off the cash flows. But within the Reliance Group, we have Reliance Jio, which is a much younger, high growth entity, which is actually a cash flow burning enterprise. But you're okay with it because you feel that it has potential. So I think within each family group, you can get a mix of companies. Obviously, the newcomers into the space all tend to be tech companies, often built around apps. It's amazing how much of new tech India is just smartphone plus, right? You look at Paytm, you take the smartphone out of the mix, the entire reason for existence goes away. But many of those companies that went public are in the young growth phase, and scaling up is the number one priority for them, often at the expense of a business model. I think what separates Paytm from Zomato at least is starting to recognize that scaling up is half the game. Making your business sticky and monetizing it is the other half. I don't think Paytm has come to that realization. I don't know whether they ever will. But I think that when you look at young companies, there's nothing inherently good about being a young company or bad about being a middle-aged company, as long as you act your age and recognize that aging is coming for you, no matter how much potential you have. You got to be ready for that, what I call bar mitzvah moment, where people say, are you ready to be grown up? And I think you have to be ready when you're a young company for that time when you get asked that question.
So let's talk about Zomato specifically. Since you've valued Zomato in the past, or you've valued Zomato just before it went public, what has changed for Zomato? Because when you valued Zomato when it was going public, it was young and charming and it was loss making, and there was complete disregard towards profitability. But now things have changed. So how would you value Zomato now?
But also, it was a restaurant food delivery business. I valued it as such because at that time, when I looked at the options, I didn't think that they could get there. And that's the thing about young companies. You look at the same company a year later, there are things that it might have done. We say, I didn't think they could pull that off. And Zomato has been impressive on some fronts. Its Blinkit acquisition allowed it essentially to start expanding its delivery business into groceries, electronics, and potentially, if you look at Zomato now, the story you would tell about the company is not so much of a delivery company anymore. It's almost like a last mile company, which is in India, that last mile is torturous because of traffic and congestion and infrastructure. So if you're a mile away from your laundry and you want to pick up your laundry, that is a 1 hour, trip. Zomato, in fact, exploiting the fact that it's strange. It's living off the fact that Indian urban infrastructure is broken. And because it's broken, you need a company like Zomato doing stuff that you used to do 20 years ago on your own. So I am impressed by the expansion. What I think the market might be missing is you're entering a very different kind of business in terms of profitability. And let me explain. When you enter the restaurant delivery business, the typical cost of a restaurant meal to the restaurant is 30 to 40% of what they charge you. The rest is what they pay the waiters, the infrastructure. So you have a 60% gross margin. So when Zomato says we can deliver your food for you, they can say, okay, you can take 20% or 22% or 25%, and they can still make money. You know what the typical gross margin for a grocer is? It's like 6, 8, maybe 10%. It's a very different business. They can't leave 22% of your order on the table. Same thing with electronics, right? If you're buying something from an electronics store, they're not going to let you keep 22% of the bill. You're scaling up, it's going to be easier to grow. But the question is, are you building in the fact that these are lower revenue slice businesses into your valuation? I'm not sure investors are. When I look at the current pricing, I think they're almost extrapolating from the restaurant business and saying they double their revenue, they double their gross billing, their revenues are going to double as well. And that might be the point on which they might get disappointed because they might get the higher gross billings on the platform, but not the revenues they expected. So it's a fast, and that's actually a feature of young companies. They will change as you look at them, which is the reason I've never felt shy about saying I was wrong. That valuation that I did a year ago on a young company doesn't hold up. It's not a sign of weakness. It's actually an acceptance of reality when you say, my valuations are good for the moment. I'm going to make my decision right now based on that valuation. And a year from now, I could be entirely wrong, in which case I clean the slate and start all over again.
How does one really account for intangibles? Power of brand, power of distribution, power of fashion, power of sudden spurt in demands when somebody has to value companies for the long term?
It's really no intangibles. It's actually very, very, very concrete, right? I mean, it's a function of if your revenue growth is single digits, there's not going to be a whole lot of change happening because you're a business that's established. Your product is known, your services are well, out there. So I think often it doesn't take a whole lot of effort to figure out where a company is in the life cycle. It's just being willing to live with that reality. The problem often is investors who invest in a company when it's a young company often hold on to that view even as that company gets middle-aged. If you bought Infosys in the 1990s, you bought a young growth company. Today, if you buy Infosys, it's a middle-aged company. It's a healthy middle-aged company, but it's a middle-aged company. So as long as you're not unrealistic about saying, I want Infosys to go back to 20% growth, it's not. It's not meant to, and I don't think the manager should try to make it go to it. Then I think you're going to be okay. So just as in life, accepting that businesses age and then being realistic about demanding what they can deliver given their age is, I think, part of a healthy relationship with companies. Because when managers and investors overreach, trying to be something they're not, is when you get those big mistakes in investing in corporate management.
I distinctly remember, Professor, a couple of years ago when we interacted with you in the same forum, you had a rather conservative view in Tata Group of companies. Why is that? And given that Chandra has now really improved capital allocation for most of the Tata companies, even though they're big and large, have you changed your view there?
I mean, I think that they are recognizing that left to their own devices, you had one company with a lot of energy left, which was TCS, dragging along a lot of aging companies. And that's not healthy for a family group. They've kind of recognized that they're trying to get. I mean, I think that one of the things you need to do as a family group is first make an inventory of every company in the group and say, be realistic. And you have to be honest, it's tough to do it because you have emotional attachments to these companies. I mean, let's face it, Tata Steel is not just another company, the Tata Group. Just like Air India, Vistara is not another company in the Tata Group. There's an emotional attachment in your family group, which goes back to maybe even 3 generations in some family groups. So I think sometimes setting that emotion aside and being realistic is the first step for a family group to inventory its holdings. I think what the Tata Group has done better in the last couple of years is be honest with itself about what these companies are, what they're capable of doing, and what they're not capable of doing. Now, does that mean they're automatically going to become young again? No, I think, but it creates the environment we can say we don't have enough young businesses in the mix. How do we go about creating some youth in the group? But I think being realistic and being honest with yourself is the first step, and the Tata Group seems to have done a good job of doing that, at least in the last couple of years.
So, Professor, allow me to throw a direct one at you. If I have to request you or urge you to identify a sector which is young, exciting, and can really be the big go-to sector in India going forward, which one would that be?
I think healthcare has to be the place we go. I mean, as I look at India, I think, let's face it, Indians historically have been underserved by healthcare, partly because a big percent of the population never went to a doctor, not even never went to a doctor, never went to a doctor during their lifetime because it was not accessible. As countries become better off, and India clearly is acquiring wealth, healthcare is going to become that discretionary product that people are going to access the most. And it's also a big chunk of money. It's not like buying a new TV, buy it and you hang it up. Healthcare is something that's an ongoing expense for many people. So I think healthcare, is the space I would look at. And I would look at companies which are not following necessarily the US route, right? Because the advantage you have as an Indian healthcare company is you don't have the legacy choices that US healthcare companies do. The US healthcare system is inefficient and expensive because so much of it is built around a structure that was created a century ago for a different US and a very different economy, but they're stuck with it. India has the advantage of starting from scratch. So I'm interested in the kinds of innovations you will see in India that bypass the traditional routes of healthcare and delivering healthcare to 1 billion people is something that no country in the world, even China, still hasn't grappled with it fully. And no country in the world has ever dealt with really well. So I'd be interested in I'm more interested in those companies, I'll be quite honest, than another app that lets me do something neat sitting in my urban apartment. I'll be quite honest, the kind of innovation that Silicon Valley has often pushed to the forefront is just, to call it innovation, I think might be an insult to the word innovation. Because what they are is taking an old way of doing business and then recognizing that you and I have smartphones and being intermediaries in the business. The Uberization of the world is now complete. Everybody's an intermediary. And that business, I know I understand the allure of the business. It's easy to scale up, but I don't think it changes our lives as much as those businesses would like us to believe they do. They just change our behavior. But healthcare has the potential for changing the lives of tens of millions of Indians. And I'm interested in companies that are starting up all over that space. I mean, none of them have had the profile of a Paytm or Zomato because it's tougher to build a healthcare business than it is to build an app-driven delivery business. But I'm keeping my eyes open for the next exciting young company. And I want to see how Indian markets are receptive to a business that requires more infrastructure investment and doesn't deliver stuff as quickly as the app-driven businesses. Do investors have the patience to do it? I mean, and if they don't, those would be my opportunities because those would be the companies that are undervalued at the time of the offering because they don't look as exciting.
Professor, you've called Indian IT companies, the traditional ones, as old US manufacturing companies, which is that they are good, but they are mature and they're past their prime. But given that everything is now getting directly impacted or affected by AI, do you think Indian IT companies can get their mojo back provided they implement the AI business correctly?
I'm talking about the large Indian tech companies, right? The large Indian tech companies had their roots in outsourcing and they were built up being support companies for, US companies that wanted to outsource a lot of the stuff. So you look at TCS, you look at HCL, you look at Infosys. Basically, they were a Wipro. You basically are looking at companies that were built around, and there were growth. There was growth there. They were exciting companies, but those companies have aged. So when I'm talking about Indian IT companies aging, I'm talking about those large companies. But Indian IT has been a lot more dynamic in the last few years in terms of startups, young companies emerging. I would like to see more depth in there rather than just another app company that can scale up. I would like to see more depth there. And I think that India has the resources let's face it, 3 of the 5 largest tech companies in the world are run by Indians. For the longest time, India has staffed the big tech revolution, but it's of US companies. So I think it might be time to bring it in-house and start building the next great Indian software company. No, I'll be quite honest though, AI is a space where the companies that are making money right now are the companies building the AI infrastructure, right? The chip companies, NVIDIA, classic example. And that doesn't surprise me. The very first companies that benefited from the internet boom were the Ciscos and the other companies that built the infrastructure. The big question with AI around the world is everybody's talking about all these incredible products and services that will come out of AI. But so far, it's been a disappointment. I mean, I notice an AI button in almost everything that I do now. My email has an AI button. And all it does is it cleans up my grammar or does, it's not something I would pay an extra $5 a month for, even $2 a month. I mean, I am low scale in terms of the consumers that they're trying to reach. There's all this great stuff from AI, but when are we going to see the results? So I think it's being sold massively, but I don't think people are buying it yet. That could change if products and services become more sophisticated. So AI is going to be the next big frontier for companies to emerge. And if it does become a big market, which I think it will the top 5 companies all still be US companies? Because every big revolution we've had in the last 4 decades, you look back and look at who are the biggest winners, they turn out to be US companies. I'd like to see at least one of those companies be an Indian company. Europe, I've zero hope for. They have almost no chance. But maybe a company in that group will. What gives Indian companies an opening is China's handicapped itself because it took its big tech players and broke their knees. Why? Because it was afraid of how much power the Tencents, the JDs, the Alibabas were making. So 5 years ago, it took them to the woodshed, broke their knees, and said, don't be so big because we're worried about how big you are. And in the process, they might have actually handicapped the companies that were best positioned to be investing money in AI right now. So I think India has an opportunity right now to step into the breach, but it's going to be hard work. Building a business is never easy. And I think that, but that will be my indicator is when I look at the top 10 market cap companies in the world 10 years from now, I see a big Indian tech company that's not around right now. That would be exciting.
Professor, for those who track your blog, and I certainly do, there is one company which you always valued every year. That's Tesla. So if given an option to value one Indian company every year, which one or which Indian company you would like to value?
You know what? I might pick Zomato as because I value companies because I'm fascinated by them. I don't care if I get them wrong. I'm fascinated by them because they're changing. So there are things that Zomato's done that I look and say, that's really good, and things where I have questions. And that's the basis for valuation. Does it mean I'll get it right? I mean, the reality of the valuation is you're right for a very brief moment of time. Then you're going to be wrong again if you measure right and wrong based on the price being different from value. So I think Zomato might become one of the companies I revisit. And if there are other young companies that catch my attention, I'll add them to my list. But you will know because when I do a valuation, I almost always write about it because to me, I mean, it drives my decisions, but it also means that the reason I write about it is I now cannot back away and say, I never said that, right? Because it's right there on paper. And I'm tired of people on CNBC getting on and having amnesia about what they told me a year ago or 2 years ago because they're hoping you don't have a recording. No, here you will have a recording, you will have the text in front of you. And it allows me to hold myself accountable for the things I get right and the things I get wrong. And that's a healthy place to be in investing in valuation.
Again, I'm bringing this point out for the benefit of our viewers. On Professor Aswath Damodaran's blog, he always has a moving number for projected returns in the market, which is centered around valuations and risk-free returns. So Professor, based on your model, if you have to look at projected returns from Indian markets after the recent run-up, what to your mind should be the anticipated and expected returns from Indian markets, assuming that we've seen a linear move in the last 3 years?
Ultimately, the returns you make on stocks come from what you pay upfront and what the expected cash flows you will get from what you pay. I don't think it's debatable. Indian stocks are extremely richly priced right now. I mean, I can see what's driving it. The India story is strong, people love it. But if you take Indian stocks and look at how they're collectively priced, I mean, I would be surprised if you made 3% more than what you can make on a government bond, an Indian government bond. That's a pretty low risk premium. So that is the India story playing out. Are people being a little too upbeat about the India story? Absolutely, because the India story has some weak links to it that right now are being covered up by the strength of growth. But I think that, it's 3 steps forward, 2 steps back. There will be disappointments. It will not be the end of the world. It is a story that's moving in the right direction. But anybody who invests in Indian stocks expecting it to be a smooth ride for the next 10 years, I think they're asking for trouble. You have to be realistic. This is going to be a story where there will be disappointments and there will be reversals. But as long as the trend line is up, you have to think of it as a win. And I think that, the India story will win, but it will have some casualties along the way in terms of people overreach.
And final question, Professor. If Aswath Damodaran of 2024 meets Aswath Damodaran of 1980s, what would the 2024 Aswath Damodaran share, indicate, or teach the young Aswath Damodaran of 1980s?
I'll say don't take yourself too seriously, right? Because I think the reality is there's so much, not just in markets, in business, that's out of your hands. That to act like you can control it because you have more data and more powerful models and you have the best people working for you is, I think, hubris. The biggest enemy in investing is hubris. And I think that the last 34 years, they've just taught me, you can do everything that you think you need to do, that you got things right. And you're going to be wrong 100% of the time. And that's okay. And I think that's the message I would send. It's a message, it's a lesson I've learned, but sometimes it's a lesson initially, at least it's a hard lesson because you're trained to believe that if you should be right. And being wrong is a sign that you did something wrong. I no longer beat myself up about mistakes I've made because I'm going to make mistakes, but also I'm going to do all the right things and it's going to look like a mistake because the world changed around me. I mean, I give the example of valuing a hotel in late 2019. I could have done everything right, but 6 months later, my valuation would have been horrifically wrong. Why? Because I wouldn't have foreseen COVID. I can't go back and beat myself up saying, how come you didn't see that coming? Because nobody did. So there are things you control and things you don't. And I call this the karmic point in valuation. You can do all you can, but there's a point in valuation. You say, I've done everything I can. I've collected all the data, used all the tools. The rest is out of my hands. And so maybe there are things in Indian philosophy you can draw on that'll make your life easier if you're an investor of valuation, because recognizing when to let go and saying it's out of my hands is, I think, a very healthy point in investing in valuation.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits. And then break right through them. Become something more. It's my time to rise.